So let's get back to our panel here. We have Greg Daco, EY Chief Economist. Also joining us is Leslie Falconio, UBS Global Wealth Management, Head of Taxable Fixed Income Strategy, and Steve Sosnick, Interactive Brokers Chief Strategist. So, Greg, let's start with you there. You had that 40K call. We are coming in quite lower than consensus at this point, 22,000. What's your reaction?
Well, I think generally speaking, we have a fairly weak jobs report here. We have all the indications that employers are being very cautious with who they hire and how much talent they want to retain on hand. One interesting note in the revisions is that we actually have the first payroll decline post-pandemic in June with a loss of 13,000 jobs. So there have been some significant downward revisions over the course of the past few months. We are on a trajectory where the labor market is not collapsing, but it is visibly softening. And this aligns with a broad range of indicators that look at job cut announcements up about 66% year to date versus last year. Continuing claims for unemployment benefits are up at their highest since 2021. And most sentiment indicators, including CEO expectations, point to more softening down the line that will weigh on income and in turn will lead to slower consumer spending activity.
Leslie, does this confirm some of the data that we've been seeing this week that the labor market is in fact softening, even though we did have the unemployment rate matching consensus estimates at 4.3%?
Yeah, I mean, absolutely. You saw that in the JOLTS data, which was below, 1% for the first time in quite a few years. And there's no question that this number is soft. But I think the market, the fixed income market is forward looking, and it's priced in quite a few cuts. Now, we all know that September, the 25 basis points was a done deal when, the chair really emphasized the one mandate side of full employment over that price stability. And I think the market really priced this in. We have, the market pricing at a terminal rate between 2.9 and 3.1. So I think the expectation of the 25 basis point cut is baked in. I don't think this is weak enough to push it to the 50. But I do think the market was already really ahead in terms of pricing in this weakness within the labor market. And we anticipated, even if this number was strong, the market was going to rally on a weak number much greater than it would back up on a strong number, simply because people would excuse the data. But to your point, what we saw from ADP, what we saw from JOLTS, the labor market is weakening, but it's not collapsing. And we know that we're going to have these supply-demand imbalances due to immigration throughout the entire year.
And we were speaking about those revisions. Like we said, July was actually revised up by 6,000, but we did see that revision for June, which Greg was mentioning, that was revised down by 27,000. So with these revisions, employment in June and July combined is 21,000 lower than previously reported. Steve, at the last jobs report, we had significantly lower revisions for the previous 2 months. Is this better than feared in a lot of ways for investors?
In some ways, yeah. I mean, I think at this point, the market's mentality is such that heads I win, tails I win, because, heads I win if the economy is a little bit weaker. Well, that reinforces the idea of rate cuts. And if the economy is a little stronger, well, that's good for stocks too, because we like a strong economy. So, the fact that there wasn't a catastrophe in this number, I think will be taken as a decent sign by the markets. So I'm seeing the bond markets, bond yields tick a little bit lower, even than where they were before. We came in with about literally a 99.7% expectation priced in by Fed Fund futures for a cut in September. This does nothing to change that narrative, and so I think that's why the reaction. It's yes, the headline payrolls number is a decent sized miss, but the rest of it is close enough to being in line that the status quo can be maintained.
Right, and to your point, I'm looking at the CME Fed Watch tool, 99% odds of that 25 basis point cut in just a few weeks in September. So Greg, when you look at the Fed, the next move, we will have CPI next week. Inflation has already started to show up for companies. Lululemon, for example, warning of some of that tariff-driven pricing pressures. Do you think, depending on what we see with inflation next week, could that change the calculus at all for the Fed? Or is this labor print weak enough to really justify that cut?
I think for September, we're pretty much going to stick with the view that the Fed is going to be easing with a 25 basis point rate cut. I think the question is very much what it does after that, October and then December, and then into 2026. We have been arguing that there is room for the Fed to neutralize monetary policy from the slightly restrictive stance that it currently holds. The reason being that underlying disinflationary momentum is still firmly in place despite the growing pressures from tariffs on the cost of goods and the cost of services that we'll continue to see. We think this will be a one-time shock, and this type of soft labor market reading confirms the fact that you're unlikely to see second round effects via the wage growth channel. You're seeing easing wage growth, less labor market strength, and so that would argue for the Fed to essentially accommodate monetary policy to a more neutral stance over the course of the next few months.
Now, Greg, going back to that non-farm payroll number, I mean, 22,000 seems weak, but I have been talking to economists over the past week or so that maybe we are in a period where we are going to see consistently lower non-payroll growth, i.e. being below 100,000. But that could still signal a healthy economy considering everything we have with the immigration crackdown as well. How do you view that? If we consistently start to see these low payroll numbers, is that a warning sign, or are there other parts of this report that investors should be more focused on?
I think generally speaking, we are in an environment where both the labor demand and labor supply side of the picture are being affected. And that's not necessarily a healthy sign. When you have a lower break-even rate, so the rate at which the unemployment rate, the rate of payrolls at which the unemployment rate does not move, that indicates that labor supply is under pressure. And while this month we did see a slight rise in labor force participation, there has been over the course of the past 6 months significant downward pressure on labor force participation as a result of immigration restrictions. So we are in an environment where traditional indicators like the unemployment rate, when they indicate an unemployment rate around 4.3%, are underestimating the softness in labor demand. And so going back to your point, going forward, yes, the break-even pace of payroll growth will be closer to 50K, maybe even zero, depending on how strong the downfall in immigration is. But as we look at the labor demand side of the picture, we have to keep in mind that that is going to be the key driver of income, and further weakness on the labor market front will weigh on income and in turn consumer spending activity, which has already started to show signs of softness in the face of these higher tariff-induced costs.
And Leslie, the change in private payrolls coming in at 38,000, the expectation was 75,000. July was also revised lower. Is that a concern for you at all when we look at the private sector?
Well, I mean, I think that was something that was expected. You know, I wouldn't say it was a current concern, but listen, job creation is slowing. There's no question. You know, we do have this, this low hire, low fire kind of environment, but we did see some increase in layoffs from that jolt, from the beige book. And that's really what the market's going to focus on. I mean, we've been really focused on that layoff level to see whether or not companies are actually laying off. And it has increased slightly, but job creation's low. There's no question. But it's really, are they laying off? That's going to be the big issue going forward in terms of how we view the economy. But we've seen a slight increase in that, like I said, in both the jolts and the beige book. We do agree that the consumer is cooling. We just don't think they're collapsing. And we've been here before in terms of the market expectations of pricing in several cuts. And I think the key to September and the FOMC will be: is it a dovish cut or is it a hawkish cut? The question of a cut is no question, right? They're going to cut. But how really he lays a foundation after that? We get a new dot plot and what his language is, and we have PPI and CPI next week, right? So I think the market is getting pretty well ahead of itself in terms of the amount of cuts. So it's really going to be the language in the September meeting that's going to dictate how the market trades for the next several months.
Yeah, and Steve, I want to bring you back in here because you said before that it does matter the why. Why is the Fed cutting? Because sometimes you don't want a cut if the labor market is rapidly deteriorating or the economy is falling apart. Again, not much reaction here for markets. But how do you view where we could be positioned post-September?
Well, I think, again, you hit on one of my key points here, and that is, the why does really matter because, sometimes you have to be careful what you wish for, and we've had this discussion before. If you're getting a rate cut because things are, going a little slowly, and maybe the Fed's going to give you a little bit of vitamin here, then a little bit of juice, then that's okay. If the economy is so weak that it requires massive rate cuts, be very careful what you wish for. We're not at the latter condition yet, which is why the market's mentality is good. Today we came into this number again, sort of a heads I win, tails I win, because it was weak. It was good enough. It was weak enough to keep the Fed on the side of cutting rates, but not weak enough to require real intervention into the economy that will upset the corporate picture. And on a day where you have something like Broadcom up double digits and some other big stocks up, there's nothing to break that momentum in the number we saw today.
All right, nothing to break that momentum. Again, we are seeing Dow futures down around 0.2%, S&P futures down just slightly there, up 0.1%, and the Nasdaq, as Steve was saying, with Broadcom and some of these other tech names leading the way higher, up roughly 0.5%. Well, Steve, Greg, Leslie, thank you all for joining us.